Let's cut through the noise. When you hear about the Federal Reserve or the Fed, you might picture a distant institution, but it's actually the beating heart of America's financial system. As the central bank of the U.S., the Fed's influence stretches far beyond Wall Street or government buildings. It reaches into every home, every wallet, and every business across the country. The decisions made by the Fed don't just impact banks or big investors. They shape your daily financial life whether you realize it or not. From the interest rates on your savings account to the cost of borrowing for a car or a home, the Fed's choices ripple through the entire economy. The Fed's dual mandate is simple in theory but complex in practice. Keep inflation under control and maximize employment. That means it's constantly balancing two huge forces, making sure your money doesn't lose value too quickly, while also helping as many people as possible find jobs. When prices for everyday goods and services start rising too fast, the Fed steps in to cool things down, often by raising interest rates. This can make borrowing more expensive, but it helps slow inflation so your paycheck goes further. On the flip side, when jobs start disappearing and the economy slows, the Fed acts to support growth, sometimes by lowering rates to encourage spending and investment, helping businesses hire and expand. The Fed's decisions affect nearly every dollar you touch: your mortgage payments, credit card interest, student loans, and even the value of your retirement savings. It's not just abstract policy, it's the reality behind your financial choices and security. This week, on September 17, 2025, the Fed made a pivotal move. After months of keeping interest rates high to fight inflation, it finally changed course, a decision that's making headlines and sending shockwaves through markets and households alike. Why now? The latest economic data painted a complicated picture. While some parts of the economy showed resilience, the job market began to weaken, raising concerns about future growth and stability. Understanding what the Fed does and why it acts is crucial for anyone who wants to make smart financial decisions. Whether you're saving for a home, planning for retirement, or just trying to make ends meet, the Fed's moves can change your plans overnight. Don't tune out. These decisions are among the most powerful forces shaping your personal economy. They can mean the difference between opportunity and challenge, between financial growth and hardship. The Fed's prescriptions for the economy can have unpredictable side effects, sometimes helping, sometimes hurting, and this week's move is a story you need to know, because it could affect your next big financial decision. So let's break down exactly what happened, what it means for your money, and why staying informed about the Fed is one of the smartest financial moves you can make. Imagine the Federal Reserve's main interest rate, the federal funds rate, as the gas and brake pedals of the entire U.S. economy. Just like a driver controls a car's speed, the Fed uses this rate to speed things up or slow them down. When the Fed wants to give the economy a boost, it presses the gas by lowering rates. This makes it cheaper for banks to borrow money, and in turn, banks pass those savings on to businesses and consumers. Lower rates mean borrowing costs drop for everyone, families, entrepreneurs, and big corporations alike. Suddenly, taking out a loan to buy a car, start a business, or use a credit card becomes more affordable. This encourages people to spend more and invest in new opportunities, which helps the economy grow. For example, lower mortgage rates can make buying a home more attractive, leading to more home sales and new construction projects. Businesses can borrow at lower rates to expand, hire new workers, or invest in equipment and technology. All of this activity creates jobs and puts more money into people's pockets. But there's a flip side. If the economy starts to overheat and prices rise too quickly, what we call inflation, the Fed has to tap the brakes. By raising interest rates, borrowing becomes more expensive. People and businesses may think twice before taking out loans or making big purchases, which helps slow down spending and cool off inflation. This constant balancing act is at the heart of the Fed's job. It's a careful dance, trying to keep the economy growing without letting it spin out of control. The Fed's decisions ripple through every part of the financial system, affecting everything from your mortgage rate to the cost of groceries. For the stock market, lower rates are often seen as good news. Companies can borrow more cheaply to fund growth, and investors may move their money out of low-yield savings accounts and into stocks, hoping for better returns. This can drive stock prices higher, but it's not always so straightforward. Investors pay close attention to why the Fed is making its move. If the Fed cuts rates because it's confident in the economy's strength, markets may rally. But if the cut is a response to warning signs, like slowing growth or a possible recession, investors can get nervous. When rate cuts are seen as a vote of confidence, stocks often surge as optimism spreads. Investors feel reassured that growth will continue, and they're willing to take more risks. But if rate cuts are viewed as a sign of trouble ahead, like the Fed is worried about a looming recession, investors may pull back, causing stock prices to fall. Fear and uncertainty can quickly ripple through the markets. The stock market is always looking ahead, trying to anticipate not just what the Fed does, but what those actions mean for the future. Every move is analyzed for clues about what's coming next. That's why this week's rate cut had such a mixed impact. The context, the reasons behind the Fed's decision, matters just as much as the decision itself. In the world of finance, understanding the story behind the numbers is everything. On September 17, 2025, the Federal Reserve made a pivotal move, cutting its benchmark interest rate by a quarter point. This was the first rate cut of the year, and it marked a significant shift in monetary policy after months of holding steady. The decision was closely watched by markets, economists, and everyday Americans alike, as it signaled a new phase in the Fed's approach to managing the economy. While this move had been widely anticipated by analysts and investors, the real suspense centered on what the Fed would communicate about its future plans. Everyone wanted to know, was this the start of a series of cuts or just a one-time adjustment? Fed Chair Jerome Powell described the decision as a risk management cut. He emphasized that it wasn't a reaction to a looming recession, but rather a proactive step as job growth began to slow and unemployment numbers edged higher. Powell made it clear that the Fed was acting to prevent small problems from becoming bigger ones, hoping to keep the recovery on track. The Fed's latest projections, known as the dot plot, suggested that 2 more rate cuts could be on the table before the end of the year. These forecasts gave markets plenty to digest, as investors tried to read between the lines and anticipate the Fed's next moves. The central message was clear: the Fed stands ready to support the economy if conditions demand it, but nothing is set in stone. Policymakers stressed that flexibility is key, and that they will respond as needed to whatever challenges arise. Every decision from here on out will depend on the latest data, especially reports on jobs, inflation, and overall economic growth. The Fed made it clear that it's not following a preset path, but instead will adjust its strategy as new information comes in. In many ways, the Fed is walking a tightrope, trying to support the job market and keep the recovery alive, but also wary of cutting rates too quickly and risking a resurgence of inflation. It's a delicate balancing act with high stakes for everyone. Investors and analysts listened intently to every word from the Fed, searching for any hint about what might come next. The financial world knows that even a small change in tone or language can move markets in a big way. The main takeaway? The Fed is being cautious, not panicked. Policymakers are prepared to act if the economy takes a turn for the worse, but they're not rushing into a series of cuts without good reason. It's a message of vigilance and readiness, rather than fear. This decision sets the stage for the months ahead, as everyone, from Wall Street to Main Street, watches for signs of what the Fed will do next. The market's reaction was anything but simple. Relief mixed with uncertainty, as investors weighed the Fed's cautious optimism against the challenges still facing the economy. The story of 2025 is just beginning to unfold. You might expect a rate cut to send stocks soaring, but the market's response was split. The Dow rose, reflecting optimism among big, established companies. But the S&P 500 slipped and the tech-heavy Nasdaq fell even more. Why? Some investors saw the Fed's move as proactive support. Others saw it as a warning sign about the economy. Smaller companies tracked by the Russell 2000 actually did well. Lower rates helped them most. But tech and growth stocks, sensitive to economic slowdowns, took a hit. The market's split reaction reveals deep uncertainty about what comes next. Investors are divided. Is this a soft landing or the start of something worse? The answer isn't clear yet. Fed Chair Powell's press conference was all about balanced jobs versus inflation. The job market is losing steam, job growth has slowed, unemployment is up, and black unemployment is rising. Powell made clear the Fed's goal of maximum employment is at risk, driving the rate cut. But inflation is still above target, at 2.9%. better than before, but not low enough. Cutting rates could help jobs, but risks reigniting inflation. That's why the Fed moved cautiously, with just a quarter-point cut. Powell emphasized, the Fed isn't on autopilot. Every move depends on new data. They're threading a needle, supporting jobs without fueling inflation. It's a tough balancing act, and the outcome is uncertain. The Fed's next steps will depend on how these risks evolve. For now, caution rules. Politics loomed large over this Fed decision. President Trump has pressured the Fed for bigger, faster cuts, hoping to boost the economy and markets. The Fed risks its credibility if it appears to bow to political demands. This week's cut was seen as a compromise, justified by data, but not as aggressive as Trump wanted. The vote wasn't unanimous. One Trump-appointed governor wanted a bigger cut, highlighting internal debate. Meanwhile, a Biden appointee's contested seat added more drama. The Fed's independence is under strain, and political battles are shaping its decisions. The stakes for the economy, and for the Fed's reputation, are high. Here's the key lesson. A rate cut isn't always good news for stocks. This week, the cut was driven by concern, especially about jobs, not optimism. When the Fed signals worry about the economy, investors get nervous. A weak job market means less spending, hurting company profits. Inflation remains a threat, too, raising fears of stagflation, slow growth, and high prices. In that scenario, the Fed's options are limited, and investors may flee to safer assets. The cut itself wasn't the problem. The diagnosis was. For many, it was a cue to take profits and brace for possible trouble ahead. The market is weighing small benefits against big risks. That's why the reaction was so cautious. Even on Fed Day, company news matters. Nvidia's stock dropped after China reportedly told tech firms to stop buying its AI chips, a major blow for a key market. Because Nvidia is so big, its fall dragged down the S&P 500 and Nasdaq. General Mills beat sales expectations but warned of cautious consumers. Its stock slipped anyway. Cracker Barrel made headlines over a logo controversy, showing how even small stories can move stocks. These examples prove the market isn't just about rates and inflation. Company news, consumer trends, and global politics all play a role. Every day brings new stories that shape the market's direction. So, what now? Don't panic, pay attention. Watch the Fed. More rate cuts are possible, but depend on new data. The job market is key. Monthly jobs reports and weekly jobless claims will signal what's next. Inflation is the other big risk. If it rises, the Fed's hands may be tied. Keep an eye on your own costs, gas, groceries, housing, and on official inflation reports. Company earnings season is coming. What businesses say about the future will matter. The intersection of Fed policy, economic data, and corporate performance will shape the market's next chapter. Stay informed, stay flexible, and you'll be ready for whatever comes. The story isn't over, it's just beginning. Your financial future depends on what happens next.